You may learn about investing and how to make the best financial decisions for your life on Investor Facts. Make sure you click the subscription button and enable the notification bell if you haven't already. Share, like, and comment. We'd had it quite easy in terms of financial market over the previous 10 to 15 years. It's fair to say, the S&P 500's earnings have almost doubled as its price has tripled during the last 10 years. It's been a terrific period of business and investors because the highest federal funds rate we've ever seen was just 2.5. The pandemic caused global upheaval, corporate closures, and collapse of the financial markets. The investing world was brought to its knees by the protracted and severe recessions. Consequently, the economy has slowed down, and to put it mildly, this has given the financial market some trouble. The stock market is looking fairly unstable. Cryptocurrency has been wrecked, real estate is sinking, and big-name corporations are now hurting. Some individuals shouldn't hold any stock at all because they simply become too disturbed by price changes. If you're going to make poor decisions because your stock drops, you shouldn't hold any stocks. Of course, more individuals realize that the basic thought of contributing is to purchase moo and offer tall. But in reality, most individuals do the exact opposite. They buy tall and after that, they offer moo. It is not cruel of them to do this, but when the times get extreme and they fear the instability, it keeps them out of the market. As individuals like Warren Buffett, Charlie Munger, Manish Pabrai, Fellow Spear, Phil Town, and all these others would say, when the market is down intensely, that's the leading time to contribute. People are very strange on that day because most of the listeners are savers, and they should want the stock market to go down. They should want to buy at a lower price in that case, but they got a feeling that they just feel better when the stocks are going up. Listen to this. We're a net buyer of stocks over time, and who wouldn't rather buy it? You know a lower price at a higher price. It's a really interesting phenomenon, and the main factor causing this backward psychology is that the majority of investors lack clear investing objectives and haven't committed to a long-term investing time horizon. As a result, when the economy is in trouble and the news is bad, instead of seizing this huge opportunity, they simply flee the possibility of immediate pain, which is a terrible course of action. Check out this timeline of the US bull and bear market since 1926. Recessions are represented by large outward bars, whereas bull markets are shown in blue and bear market in orange. There have been 15 recessions and 11 bear markets since 1926, making a total of 12 if the 2020 decline is included. There were a total of 14.7 years of bear markets, and there were 75.4 years of bull markets to go along with that. Following the subsequent bear market, you earned 43 in 1.8 years, 210 in 4.1 years, and 908 over 14.8 years, and so on. If you were the person who put your money where your mouth was, at the lowest point of each of the largest bear markets in recent history. I love this chart that Tony Robbins included in his book Unshakable. Just a year later, you would have given back 20, 30, 40, and 50% of this, even if it's impossible to predict the market bottom precisely. You probably won't get those returns exactly. It does demonstrate the size of the opportunity that the bear market might present. For instance, you would have made around 9% on your investment if you had bought at the market's peak before 2020 COVID dip, but you would have made nearly 60% more if you had bought it at the market's low just a few weeks later. This is how much of a difference your entry point can make. And keep in mind from the chart that huge declines like this occur very infrequently, with only 14.7 years between bear markets and bull runs. Okay, I get that recession present great possibilities, But how can I truly take advantage of this chance as an investor without making terrible error? The first stage, whether you choose to invest actively or passively, is to be informed about market development so that you can recognize when these chances arise. The second step is to effectively implement your strategy. Step 1 is to keep yourself informed, but step 2, which is vital, is to effectively carry out your investing strategy when you see market volatility. As we all know, there are two basic approaches to long-term investment, either dollar cost averaging or long-term value investing in the vein of Warren Buffett. They're going to pick dollar cost averaging, which is basically taking your money and spending it across the entire stock market using something like an index fund. For people who don't know what it is, they select a market tracking investment, and investors then deposit the same amount into the market tracking investment at regular intervals, such as $2,000 every 6 months or something similar. Your money is then distributed over the whole market through the index fund. The goal of this strategy is to completely remove emotion from the investment process while still allowing you to benefit from the market's long-term performance, which is approximately 10% per year for the S&P 500. However, you won't need to worry about your investment or spend time reading annual reports or anything else of that sort. At first glance, this technique obviously doesn't seem to be about timing, and specifically capitalizing on the incredible opportunity that is a stock market crash, but in reality, it is. Since, let's face it, $2,000 won't get you as many shares when the stock market is really high. When the market crashed a year later, your $2,000 bought you 20.5 shares. It was brilliant. Dollar cost averaging is a great way to passive investors to take advantage of market crashes by continuing to do what they do while going above and beyond passive investing. It's only natural to buy a lot more shares when the price is lower and much fewer shares when it's higher, but you haven't had to change anything about your investing habits. It would take around 8 hours because that is the exact topic of an introduction to stock analysis. But I did want to touch on how active investors can make sure they won't lose money when investing during this unstable economic period in this video. In such a setting, how can you be sure that a business will be able to survive? As we've just discussed, the company you're considering must have pricing power. Pricing power is the ability to raise prices without experiencing a decline in sales as a result of their competitive position. In fact, despite rising prices, they increased drink sales by 8% and concentrated sales by 4% in Q2. This trait is essential for success in an inflationary environment. The greatest approach to ensure that your firms perform well during this period is to make sure you have a small amount of debt. For example, Google has more cash than they do debt, as this is, of course, the main effect of rising interest rates. Do you think this business model will last? For instance, grocery stores often operate better during economic downturns since consumers obviously can't stop purchasing necessities. There are many things to think about, but for active investors, it's important to consider business models, pricing power, and debt levels. For passive investors, just keep on keeping on. Stay strong and go long. Holiday plans might be scraped as the cost of living eats up more discretionary income. Overall, though, this is the reason why recessions offer such great chances. Hopefully, this video has given you the information you need to fully benefit. Thanks for watching the entire clip. If you like it, kindly let us know by hitting the like and subscribe buttons. Also, don't forget to enable the notification bell so you can be the first to know when we post a new video. In the following video, I'll see you. Goodbye.